The extended lockdown to combat COVID-19 has an economic cost in terms of output loss, lower corporate earnings, supply disruption, and demand destruction. Let's do a three-point analysis to understand the extent of the impact on Indian companies and what is the price they may have to pay. 1. India Inc. stares at a crisis. Well, for large cap companies, the EBITDA decline could be as much as 13% under a short period of lockdown and 26% under an extended one. This worsens for smaller companies with pain in interest servicing as well. Mid and small companies are likely to resort to significant retrenchment, hampering their long-term prospects as well. The output loss due to the lockdown and lower earnings due to the supply disruption and demand destruction owing to a widespread job loss and pay cuts will have to be borne by the companies themselves. In some sectors, the new way of life, social distancing and living with the virus threat might warrant a business model change and lead to unviability of several businesses as well. The scenario may turn critical if corporates do not have access to emergency funding to tide over the cash flow constraint. 2. Sectors which one needs to be watchful about. Well, although a majority of IT companies have zero leverage and possess significant cash, the business disruption and the evolving crisis in the US and Europe means their receivables are likely to shoot up. Execution will therefore be severely affected, and with employee costs as a percentage of the total cost being upwards of about 70%, smaller companies will have to resort to significant retrenchment to stay afloat. And this in turn will impair their ability to get back to business and should the demand revive later. Now, infrastructure and construction sectors depend heavily on borrowed funds. The sector will be affected on three counts. Firstly, execution will suffer because of the lockdown and the availability of resources such as labor and equipment. Besides, clients would most probably delay the construction of projects in the light of financial resources as well. Second of all, the payment cycles will also extend and cost will increase because of the idle resources like equipment. Overall, there would be a very high pressure on working capital and on cash flows, thus eroding the company's ability to service the debt and interest cost. 3. What should investors do? Well, most large companies have a better quality of balance sheet with a relatively lower leverage and will perhaps come out of this crisis earlier. Many smaller companies, though, already have much lower interest service coverage ratio and should therefore be avoided at all counts. Thus, investors should largely look at opportunities in the large cap space and the large mid cap buckets, and that too selectively during this kind of correction.